Taxes don't stop in retirement. In fact, for many, they become more complicated. These are 5 of the most common tax traps that we see. So let me give you the first one to tee you up, Dad. Thinking Social Security is tax-free.
Oh, yeah. And you know what? Part of that, too, it's we live in Connecticut. And in Connecticut, up to a certain income level, Social Security, there are no taxes on Social Security, depending on whether you're single, married, and hitting those thresholds. But the big issue, though, is on the federal level, it's still taxable. And I can't tell you how many people have come into our office and they say, oh, no, I don't pay anything on social. Like, oh, actually, you do. And I got to break the bad news to them. So it shocks them a little bit. On top of it, what I want to point out is with Social Security, there is a little tax deduction added for seniors this past year. It goes for 3 years. That ends in 3 years. So it makes it look as if your social's not taxed at all, but in reality, it really is. The number 2 trap that we run into, required minimum distributions, pushing you into higher tax brackets. How many times have we seen that?
Countless of times. People are retired 65 and they want to just take the least amount of tax as possible. They might pull from their retirement account, their bank savings, and those 401ks, those tax deferred accounts keep growing and growing and growing on you. And when you get to 73 or 75, you're required to start taking money out of those tax deferred accounts. And it could mess up a whole bunch of things. I mean, it could mess up your federal and state tax code. That can go up. Medicare premiums can go up. So you want to start really planning once you retire or getting closer to that required minimum distribution age. You plan earlier, you can help yourself. So next topic for you, Dad, Medicare IRMA. We know that could creep in there as well.
Oh, yeah. People call it the stealth tax. Kind of just sneaks in there. And it's so a lot of the planning that we do, we'll look at, the brackets, but then you hit this IRMA bracket where you have to pay more for your Medicare. And you'd be like, well, how does that happen? It's just you hit certain income levels and it's added in. On top of it, I will tell you this, for couples, we've got a lot of room. Unfortunately, for couples, if one passes or if someone's just single, they're not married, that sneaks in a lot quicker. So the scary thing is, yes, it's an extra charge on your Medicare that is created. But the part that I really want to push is getting into the first bracket isn't all that bad. If there's things that you want to do, you want to live life, you want to, you want to make those memories. So sometimes when I put it on paper in front of someone and I say, hey, you're going to get into that first bracket of Medicare, it's going to cost you a little bit more, that stealth tax, but it's really not that bad. You're still going to be able to do all the things you wanted to do. You're just going to pay a little extra on your Medicare. Showing someone that sometimes you're okay dealing with it. Okay. But if it's a big jump, because they're looking to do conversions, then it's an issue. So we really got to know the numbers, got to put the numbers in front of someone. So Nick, I'm going to give you another tax that pops up that a lot of people aren't even aware of, and they actually create it themselves, drawing in retirement sometimes. Poor withdrawal sequencing.
Yeah, and that's one thing that you really got to look at your short versus long-term effect on your tax code. So to give you a perfect example, so I had a client, they were pulling all their money from their IRA when they first started retirement, and they didn't have an RMD issue for them. So for them, it was more of a withdrawal sequence. It should be, okay, let's plan for taxes year after year, and we don't have to worry about the RMD for them as much. And because of doing that, they were paying $5,500 in taxes. They had a good balance of Roth money, non-retirement money. And what happened was we got them from $5,500 down to $0 in taxes the last 3 years, which is huge. That's the big thing, kind of looking at what your plan shows to come up with that withdrawal sequence to give yourself the best advantage moving forward. Yeah, maybe we can get your tax down from 10 to 7. Maybe we are paying a little extra taxes ahead so that you don't have these Medicare jumps and RMD issues down the road. So you really want to look at your plan when you're building out your withdrawal sequence. And the last topic, Dad, is ignoring those Roth conversion windows. When's the best time to do that?
Oh, yeah. And for some people, and so I'm actually going to give a couple examples. For some people that retire a little bit early, so let's pretend they retire at 62. A lot of times between 62 and about 73 or 75, those may be their lowest tax years. And what I mean by that is sometimes they're just drawing social. They might have a pension, might not, and then they're taking some money out of accounts. And Social Security is not taxed the same way as money coming out of those IRAs. So sometimes what we're doing, and it's always putting it on paper, we'll actually have clients do Roth conversions. So it looks like income on the tax form because what they're doing is taking money out of IRAs, moving that money and putting it into a Roth. So they're paying tax, looks like income, but what you're doing is you're working the brackets. And by working the brackets, you might bring a little bit more tax into the picture now, but in the future, it's helping them out with future possible tax issues. Some people oversave. And what I mean by oversave, they saved a lot in those 401ks. And what happens when they reach that required minimum distribution age at 73 or 75, they have to take money out. And sometimes the amount they have to take out by the IRS rules is large, which creates a bunch of taxes. So by getting ahead of it, you're trying to fix a problem. There's one other little benefit to fixing that problem too, is if they have kids or beneficiaries that they're trying to pass this money on to, what they're doing is shielding that money from future tax hikes so that money moves along more efficiently to their loved ones. So the loved ones, a lot of times when you chart it out, will end up with more. Because they're not paying as much in taxes when they inherit it. So I always say to people, would you rather leave the IRS more money or your kids more money? And pretty much the answer is always my kids. So those are the 5 tax topics that I have.
I'll give you some bullet points to start looking for those things. Know what adds to your taxable income, number 1. Number 2, don't wait until the IRS forces your withdrawals. Number 3, before making a move, ask, will this raise my taxes or Medicare premium? So all these things kind of coincide, making sure where you pull the money from your IRAs to your 401ks. This can cause tax issues, jump up your taxes and your Medicare premiums, and use those low tax years while you still have them. It's going to be huge to help with that tax planning. So if you do have any questions, feel free to reach out at tfcheckup.com or click the link below.